What if I told you that some wealthy Americans legally pay a lower tax rate than many middle-class workers? It sounds unfair at first, but the truth is that the US tax code is filled with incentives designed to reward certain financial behaviors. The wealthy are not necessarily hiding money offshore or breaking the law. In many cases, they are simply taking advantage of tax strategies that have been available for years while the average taxpayer remains completely unaware of them. Today, we are uncovering 12 powerful tax strategies the IRS allows that can help reduce taxable income, protect wealth, and keep more money working for you. By the end of this video, you'll understand why taxes are often less about how much you earn and more about how much of the tax code you understand. One of the biggest differences between wealthy individuals and average earners is how they view income. Most people earn money through a paycheck, which is heavily taxed before they even see it. Wealthy individuals often focus on investment income, business income, and capital gains, which can receive more favorable tax treatment. Instead of relying solely on wages, they build assets that generate income in ways that may qualify for lower tax rates. This shift in mindset is one of the foundations of long-term wealth building and tax efficiency. Another strategy involves maximizing contributions to tax-advantaged retirement accounts. Accounts like a traditional 401k September era, solo 401k and other retirement vehicles can significantly reduce current taxable income while allowing investments to grow tax-deferred for decades. High earners often contribute the maximum allowed amount every year because they understand that every dollar sheltered today can potentially compound into many more dollars tomorrow. The tax savings become even more powerful when combined with employer contributions and long-term market growth. Wealthy investors also understand the power of Roth accounts. While contributions may not reduce taxes immediately, qualified withdrawals can be completely tax-free in retirement. Many high-income individuals use advanced Roth conversion strategies during lower-income years to move assets into tax-free environments. This creates flexibility later in life and can help reduce future tax burdens while preserving more wealth for heirs. Real estate remains one of the most powerful tax tools available in America. Rental property owners can often deduct expenses related to maintenance, property management, mortgage interest, insurance, and repairs. Even more importantly, the IRS allows depreciation, which lets property owners claim a non-cash expense that can reduce taxable income despite the property potentially increasing in market value. This unique combination makes real estate one of the most tax-efficient wealth-building vehicles available. Wealthy real estate investors frequently take advantage of the 1031 exchange. This provision allows investors to sell one investment property and reinvest the proceeds into another qualifying property without immediately paying capital gains taxes. Instead of losing a large portion of profits to taxes after each sale, they continue rolling gains forward and allowing their investments to grow. Over decades, this strategy can significantly accelerate wealth accumulation. Another commonly used strategy is tax loss harvesting. Investors regularly review their portfolios for assets that have declined in value. By strategically selling losing investments, they can offset taxable gains generated elsewhere. This helps reduce overall tax liability while maintaining a long-term investment strategy. Many sophisticated investors use this technique year after year to improve after-tax returns without fundamentally changing their financial goals. Business ownership provides another layer of tax advantages. Entrepreneurs can often deduct legitimate business expenses including equipment, software, travel, office costs, professional services, and other operational necessities. Wealthy individuals frequently structure income through businesses because the tax code offers numerous incentives for entrepreneurship and economic activity. While these deductions must be legitimate and properly documented, they can substantially reduce taxable income when used correctly. One lesser-known strategy involves the qualified business income deduction. Depending on the type of business and income level, certain business owners may qualify for a deduction that effectively reduces the amount of income subject to federal taxes. This provision has become a valuable planning tool for many self-employed professionals, consultants, freelancers, and small business owners who want to optimize their tax situation legally. Charitable giving is another powerful strategy used by affluent households. Beyond supporting causes they care about, wealthy donors often structure charitable contributions in tax-efficient ways. Donor-advised funds, appreciated stock donations, and charitable trusts can provide meaningful tax benefits while allowing individuals to make a positive impact. Rather than donating cash, many choose to donate appreciated assets, potentially avoiding capital gains taxes while still receiving charitable deductions. Wealthy families also focus heavily on long-term estate planning. Trusts are commonly used to manage assets, protect wealth, and create tax efficiencies for future generations. While trusts can sound complicated, their purpose is often straightforward: preserve assets, maintain control over distributions, and reduce unnecessary tax exposure. Effective estate planning ensures that more wealth stays within the family rather than being lost through inefficient transfers. Another important concept is borrowing against assets instead of selling them. High net worth individuals often hold significant investments that have appreciated substantially over time. Rather than selling those assets and triggering taxable gains, they may use asset-backed loans to access liquidity. Because loans are generally not considered taxable income, this strategy can provide spending power while allowing investments to remain intact and continue growing. The wealthy also pay close attention to timing. Strategic timing of income, deductions, asset sales, and retirement distributions can significantly influence annual tax bills. Small decisions made at the right time can result in thousands or even tens of thousands of dollars in tax savings. This is why successful investors and business owners frequently work with accountants, tax attorneys, and financial planners throughout the year rather than waiting until tax season arrives. Perhaps the most important lesson is that the tax code often rewards investment, entrepreneurship, long-term planning, and asset ownership. The wealthy understand this principle and organize their financial lives around it. They don't simply focus on earning more money, they focus on keeping more of what they earn. Every dollar saved in taxes becomes another dollar available for investing, compounding, and building future wealth. At the end of the day, the biggest tax advantage isn't a secret loophole hidden from ordinary Americans. It's knowledge. The IRS publishes rules that are available to everyone, yet most people never take the time to understand how those rules work. The wealthy study the system, seek professional guidance, and structure their finances accordingly. While not every strategy applies to every person, understanding these concepts can completely change the way you think about money, investing, and long-term wealth creation. If you found this breakdown valuable, make sure to subscribe, because financial success isn't just about making money, it's about learning how to keep it.